All right. Welcome to, I would say, webinar number 7. It looked like I was going to have a cat battle over here. It's a standoff. No, but welcome to webinar number 7. Should you buy gold? We appreciate you taking the time to hopefully learn a couple things. Just a quick housekeeping item. Patrick, are you there?
I am. I cannot start my video though. You might be able to do that, but yep, as per usual, if anyone has any issues seeing anything, hearing anything, shoot us a quick email, info@oceansideadvisors.com. I'd be happy to help you out to the best of my abilities. Also, we'll be answering some questions at the end. You should see a little Q&A button at the bottom of the panel there. If anything comes up during the webinar, just fire your question in there and I'll make a note of it, try to get to 2 or 3 of those at the end.
Good stuff, thanks. All right, so the topic of the webinar this week, should you buy gold? All right, so this, of course, is a topic that seems to get a lot of attention in periods of time when gold is performing particularly well. I think it is important during these times to recognize that not all of the advice you might be hearing or receiving it might not be the best advice. Not surprisingly, many times there are conflicts of interest there. Trying to sell you gold, of course. And so the goal of the next half hour here is simply to try to provide some objective data in terms of the history of gold, kind of past returns, correlations, how gold interacts with your other investable assets. And then for you to be able to take that information and if you are managing money on your own to be able to help you make the decision whether it belongs in your portfolio or not. And for those of you that we already help with some of your assets, you'll get a good look at the way we do things and the way we view it and when it should not be a part of your portfolio. So I think early on here, it's important to point out that anytime you hear things about gold, like there's usually 2 very different conversations when discussing the prospects of gold. Like the first conversation is long-term returns, diversification, correlations, how it fits within an investment portfolio. The second conversation is more so like doomsday, end of financial markets, economic collapse, like those things of that nature. And although we'll touch a little bit on the latter towards the end, we're going to pull up a study of some countries in the past that saw their currencies fail. But for the majority of today, we're going to be discussing that conversation 1, how it fits in your portfolio. Without question, that's more so where my expertise comes into play. And certainly I know there's a lot of books you can read and so forth on topic 2 there. So let's dig in here. Okay, disclaimer. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Of course, we'd be happy to provide you with this advice, but we need to get to know you and your personal situation a little bit better. You might notice there I threw in Scrooge McDuck on the disclaimer page. Patrick had put together a bunch of pictures and things for me to enter throughout this webinar, and I couldn't find a good place to put Scrooge McDuck, but I felt like, this picture of him diving into an ocean of gold was appropriate. But nonetheless, all right. So I think it's helpful to start like what gives gold its value. All right. So just some basics here. Why is gold valuable? All right. So for starters, gold is more malleable and ductile than any other metal. All right. So it can be stretched into a wire or beaten into thinner sheet. Just a really neat metal. It's resistant to corrosion. It does not oxidize. Probably most importantly, it's extremely scarce. All right, and although it's believed that there's far more gold under the oceans than up on land, at this point, the price of gold hasn't justified companies developing the technology to mine that gold underwater. So it's extremely scarce. And if it weren't for this scarcity, you would see it used a lot more in production, right? But given there's just not a lot of it, it doesn't make sense from a net present value standpoint for companies to use it as a means of production. Gold has always been a symbol of wealth, right? So from simple things like jewelry to for centuries, kings and queens have used gold to display their wealth. Saddam Hussein, of course, when they raided his palace, had gold all over, and even his toilets were gold. Kind of shows the character of Saddam. But it's all gold's also a means of exchange, right? So not so much these days, but certainly in the past, gold was used as a means of currency. All right, I thought it might be helpful just to pull up a quick chart of the price of gold per ounce since the year 1975. All right, so it was close to $1,000 an ounce, about $800 back here in the 70s, and then of course had a nice run up kind of throughout the early 2000s. Peaked in about 2011, where it was close to the same price it is today. Basically got cut in half, and then has since recovered to make a new high recently. And this is where you've seen a lot of the headlines about gold. But I thought it'd be nice to kind of start with the last 40 years or so here, 45 years. So in this period of time, we have gold's returned about 170%, all right, in the last 40 or so years. What that equates, so that comes out to a nominal return of about 3.5% a year. I think it's going to be important for the rest of our conversation that I distinguish the difference between a nominal return and a real return. Kind of take you back to economics. All right, so a nominal return, that's the return you see on your statement, right? So for example, gold goes up on your account statement, let's say 3.5%, like it has the average year over the last 40 here. So 3.5%, that would be considered your nominal return. All right, your real return backs inflation out of that number, right? So for example, like this same time period over the last 40 some years, inflation has averaged about 3%. Of course, most of that came earlier in this time period, but over this time, inflation's been about 3%. So if the nominal return for gold in this time period has been 3.5%, your real return, so your inflation adjusted return, would be 0.5%. All right, so one half of 1%. And we'll dig into that a little bit deeper here in some later slides. We're worth pointing out though, just while we have the chart here, so again, here gold peaked in 2011, right? And it's just when you hear the media and how awesome gold is, I think it's a good starting point just to recognize that in the last 10 years, gold has been one of the worst asset classes you could ever own, right? So in a period of time where fixed income's done well, equities have done well, gold is basically flat, just slightly higher in the last 10 years. So just keep that in mind when everyone's saying how rosy things look for gold. Common reasons people own gold. All right, we're going to touch on each of these. Some people own gold as an inflation hedge. All right. Others own it as an investment. All right, for diversification purposes or just straight speculation, hoping to earn a high return. I think some other people own it kind of as a hedge against a potential financial market collapse. And we're going to have a slide on that at the end. All right, so let's start with this first reason people tend to want to own gold. All right, so is gold a good hedge against inflation? All right, and the answer here is historically yes and no. And we'll dig in a little bit deeper what I mean by that. So there's a really good research paper that I would encourage any of you to read on this topic. It's titled The Golden Dilemma, written by Claude Erb and Campbell Harvey back in 2013. And they went way back, thousands of years back to study the history of gold. And what they found in the very long run, gold has proven to be a good hedge against inflation. I thought this was really interesting. So the wage of a Roman centurion during the rule of Emperor Augustus, so over 2,000 years ago. So the wage of a Roman centurion was about the same as today's wage of a US Army captain when both are measured in gold. So I thought that was really neat. Similarly, the price of bread today is also roughly the same as 2,000 years ago if you were to price both in gold. All right, so without question, in the very long run, gold has proven to be a good hedge against inflation. All right. In the shorter term, the answer to that is not quite as much. Okay, so in the short run, Erb and Harvey, they're using 10 and 20-year rolling periods. And what they found is that gold typically moves significantly above or below the consumer price index. All right, so just a couple quotes out of their research. So they stated here, gold is a volatile asset. That's going to be an important part that we're going to discuss later. But gold is a very volatile asset that is likely to undershoot and overshoot any notion of fair value. Okay, so you're going to get these wild swings. They found that's inevitable through time. The other quote they have, even if one has a firm grasp on the probability of hyperinflation in a country, that says nothing about whether or not the real price of gold will maintain its purchasing power during the experience. All right, and this is going to tie in a little bit with the slide that we're going to have at the end, where we do kind of look at some countries that have where their currencies have failed. But an important point here, like even if one has a firm grasp on the probability of hyperinflation in a country, that says nothing about whether or not the real price of gold will maintain its purchasing power during the experience. All right, so the second point here, or second reason that people tend to want to own gold, is it a good investment? All right, so a really important point here is number one, gold is a non-cash flow producing asset, right? Like you don't receive a dividend, you don't receive interest, or it's a non-cash flow producing asset. And so not surprisingly, that's why, as we discussed earlier, over the last 2,000 years, the return on gold has been inflation, right? So the expected real return of gold at any given time is 0%, right? So again, you're going to have periods of time where it does extremely well and it far outpaces inflation. And there are going to be other times where gold is crashing in price and that does not keep up at all. In terms of a correlation to stocks, okay, so we're going to have to do just a quick 101 on portfolio management and what correlation means. Okay, so correlation is a range between -1 on one extreme and 1, +1 on the other extreme. Okay, and so what correlation measures is how two different assets move with each other. All right, so a simple example of two assets that would have a perfect correlation. So perfect correlation, we call that 1. That would mean asset A increases 5% in price. If we have a perfect correlation of 1, that would mean that asset B would also increase 5% in price. So the exact same. If asset A were to go down 10%, asset B would also go down 10%. All right. On the other extreme, a correlation of -1, which we call negative correlation, sometimes referred to as inverse correlation. What you have on that extreme is if asset A were to increase 5%, in that same time period, we would expect asset B to decline 5%, right? So they're doing the exact inverse, the opposites. Interestingly, so gold has a correlation of 0.085. I'm just going to round that to 0, right? So that you can kind of think of 0 as the midpoint. All right. So what does that mean? Basically what that means in practice is gold's price movements are going to move independent of what stocks are doing, right? So if a correlation is 0 and stocks are up 5%, I have no idea what gold would be doing in that same time period. Gold might be up 5%, but it also might be down 5% or up 2%. It means nothing. If stocks are down 5%, maybe gold's up 5%. So a correlation of 0, it just means that the two assets are trade completely independent of one another. So why that's important in terms of portfolio management is, given this low correlation to stocks, you can make a strong argument that owning gold for diversification purposes makes sense, right? So if capital preservation is one of your objectives, so if for example, we tend to help a lot of retirees. A lot of times retirees want to be a little less aggressive, so more moderate to moderate conservative portfolio allocations. You can make a really strong case from a capital preservation standpoint that gold would make sense, right? Because stocks could be going down, or up, and gold is likely doing something totally random, right? So from a diversification standpoint, it makes sense. But keep in mind, even with the benefits of diversification, your expected real return is still 0. It's still inflation, right? That's how gold's been priced for the last 2,000 years. The expected return is inflation, so it's 0. And to quote Jack Bogle, who founded Vanguard, obviously a really bright guy, that this was his opinion on whether or not gold is a good investment. His quote: "In the long run, it, being gold, is a loser's game. It has no internal rate of return. Bonds have interest rates, stocks have dividends or earnings growth. Gold has nothing. It is complete speculation. If you're enamored with gold, owning 5% is okay." All right, now Warren Buffett, we'll just go from one bright guy to the other. So you might have seen in the headlines just the last couple of days that Warren Buffett bought a gold stock. All right, and I think it's important to make the distinction between buying gold and buying a gold stock, right? So a company that's producing gold is paying a dividend. Like, it does have earnings growth. So it's much different than owning the underlying commodity, right? So back in 2012, Warren Buffett's made it really clear what he thinks, about owning gold. So he provided us with this analogy, and at this time, the world's gold stock was worth about 9.6 trillion US dollars. All right, now this is kind of a long quote, but it's I think it illustrates an important point. All right, so with that 9.6 trillion US dollars, Warren says, you could buy all of the cropland in the United States, 400 million acres with roughly 200 billion of annual output. And you could buy 16 Exxon Mobils, each one earning 40 billion annually. Still, after buying those assets, there's 1 trillion US dollars in cash left over. A century from now, the 400 million acres of farmland will have produced a massive amount of output. Exxon will have produced trillions of dollars in profits. The gold, on the other hand, will have remained unchanged in size and will still be unable to produce anything. And he adds on to that, gold is not an asset with any output. Gold will always be gold, and it will be worth whatever someone is willing to pay for it. We may hope that it will maintain its real value, meaning an inflation-adjusted return of 0, but historically it has had a very volatile real value. All right, so, and to that point, I was thinking of showing another study, but you want to confuse an economics professor. So the demand for gold, try to make sense of this. The demand for gold actually increases as its price gets higher. Right, so ask an economics professor about that, because obviously supply and demand, you would expect more demand as prices go down, but with gold, historically, its demand goes higher as its price goes higher, which probably is just an example of the way narratives have worked all along. All right, and then so again, this third reason people tend to own gold or want to own gold, is gold a good hedge against a potential collapse of financial markets? All right, so again, going back to the study by Erb and Harvey, what they did, they studied 56 separate instances of financial collapse throughout the 20th century. All right, and they were pulling data from both developed and emerging countries. So, your Brazils, like we're going to touch on here in just a minute, but also, that's going to include like Germany post World War II, where currencies lost nearly all of their purchasing power. Right, and the primary the primary conclusion that they found during these different currency collapse situations, so they found gold may or may not maintain its purchasing power during times of financial collapse. And if you think about it, if you think about it hard, that shouldn't come as too much of a surprise, right? So just because, well, I'll just do this next example first and we'll expand on it. But here's Brazil. So from 1980 to 2000, Brazil's currency lost all of its value. So, one might think, someone living in Brazil could have invested in gold, during this time. But so the real price of gold during the same period, again, down 70%, right? So now having 30% of your worth is probably better than having zero. But at the same time, it just goes to show, like, when currencies are losing their value, like gold during that period of time may or may not be in one of its boom or bust cycles. Gold is going to be, it's going to trade independently, and so if you think about it, like, that makes sense, right? So many of the times when we look at the quote of gold, we look at it in US dollars, right? Whereas someone in Germany is going to be looking at the price of gold in euros, right? But ultimately, gold, the underlying value is simply what someone's going to pay for it. So if you own gold in Brazil and your currency's crashing, like, why would the price, the real purchasing power price of gold increase just because your currency's crashing, right? That gold is going to be the same amount of gold that somebody in Germany has, someone in the United States has, someone in Russia has. And it's going to be trading independent. The worth is going to be independent of what's going on with the currency. Okay, so I guess we just kind of touched on this, but the real price changes of gold appear independent, and this is over 56 different instances of financial collapse throughout the 20th century. But it appears that the price of gold is independent of the environment in a given country, and gold may have nice returns, but it just as easily and at the same probability, gold may have substantial negative real returns during periods of hyperinflation. So, and last little point here, and again, I won't at all pretend to be survivalist expert, but I have read in a hypothetical economic collapse, like, you might be better off owning silver, right? At $28 an ounce, like, there's a decent chance that would be a better means of exchange, right? To buy food or whatever that might be. So, so to kind of wrap up today, I was trying to make this a little bit shorter. But so in conclusion, this is kind of the way that we feel you should look at it. And then of course come to your own conclusions. But what we do and what we believe is, for diversification purposes, like, we think a small percentage of gold belongs in conservative and moderate risk portfolios, right? So for the reasons that we mentioned earlier, like, if we do encounter a period of poor equity returns, having that piece of gold in the portfolio provides that layer of diversification where it helps from a capital preservation standpoint. So for that reason, like in our portfolios, we typically have 3 to 4%, depending upon how conservative and how much of, if it's more of a primary objective, capital preservation, like, we'll be on the higher side of that. Second point would be, given the expected real return of gold is zero, like, although volatile, there's going to be great periods, there's going to be very poor periods. Given the expected real return of gold is zero, we do not think gold should be allocated in growth in aggressive portfolios, right? It's too much. The benefits of diversification are outweighed by the opportunity cost of having income producing assets, things that have interest, dividends, earnings growth. And lastly, given the benefit of owning gold during periods of currency collapse seems to be mixed at best, we would recommend those who want to own gold, or silver coins, only purchase in reasonable quantities. So with that, I'm interested to see what kind of questions we might have. That was, I know I went kind of quickly there, but in a nutshell, I wanted to pull up just some real data on the expected return of gold, and hopefully let everyone come to their own conclusions. Because when I see the headlines, I never see anyone saying the expected return of gold is zero, like it has been the last 2,000 years. You know, you turn on CNBC and people are predicting it to be, you know, $15,000 an ounce or $100,000 an ounce. And although they may be right, like it's certainly the previous 2,000 years doesn't suggest that might be the case. So any questions there, Patrick?
Yeah, right when you started the webinar, my internet cut out. So I was scrambling for the first 15 minutes of the webinar, but it looked like you at least had some thought-provoking dialogue about gold here. A lot of good questions. We got one from Alice. Should I buy gold for my grandchildren?
Hi, Alice. Should you buy gold for your grandchildren? Probably not, for the reasons that that second bullet point of the last slide. Given the expected return, the expected real return, so inflation adjusted return is 0. I think there's probably better longer term opportunities for your grandchildren. With that being said, if there's a shorter term objective, right? So if I don't know what that might be, but if there's something that you're trying to do for your grandchildren, like early in their lives, early in your grandchildren's lives, like, and capital preservation is an objective, then for the reasons we stated in bullet point number 1, the diversification benefits, maybe, but most of the time when we're planning, you know, finances for grandchildren of clients, growth is the primary objective, and if that's the case, then I would say no.
All right, we got try to get to 2 more here. One from John, question that I like, and I think I've asked you about this before. Can I hold physical gold coins in my IRA?
Can you hold physical gold coins in your IRA? The answer to that is yes. You can own physical gold coins in your IRA, but it's tricky because you can't own them like at your house. You can't have the gold coins sitting at your house and you sit there and say, hey, like these coins are in my IRA. Like it doesn't work like that. So the IRS requires a qualified custodian hold the assets, hold the coins, which means obviously you'd have to have like an IRA set up with a bank that would hold the gold coins in like some kind of safety deposit box. But the same rules for IRA is going to apply to those coins. So for example, if you're younger than 59 and a half and you want to get those coins out, you're going to be in a tight spot because they're still going to want to charge you, 10% premature withdrawal penalty. You're still going to have to pay ordinary income taxes somehow. And given the coins are not exactly liquid, I don't know. I think you'd be in a tough spot with the bank trying to develop. How much are the coins worth? And really, if we go to if we look at what we just went over, and again a hypothetical absolute collapse of financial markets, I would say good luck trying to get your gold out of your IRA as a means of to barter. I don't like the chances of the bank opening their doors and letting the gold get out of there. So if you want to own gold coins, I would suggest you do that with after-tax dollars, so you can actually have the coins at your house. I think that makes far more sense than owning physical gold in your IRA. Hopefully that was probably too long of an answer for the question.
I think that was pretty thorough. And given how I think you're going to answer this one, we'll make this our last question from Frank. You mentioned the correlation of stocks to gold is 0. Can you provide the correlation of stocks to other asset classes?
Oh, that's a really good question, Frank. Yeah, great. So Frank, so again, going back to the correlation, right? So correlation, it runs in a range of -1 to 1. And gold just happens to be right at the midpoint of 0. So the question is, how do other asset classes what is their correlation with stocks? And that's a tricky question because correlations are always changing, right? Because as circumstances change, different market pressures, like it doesn't happen in like a straight line. But just to give you like some very rough figures on what to expect. So like United States stocks would have a correlation with international stocks of like 0.6. Right, so without question, a positive correlation. So if you see the U.S. markets going down, it's quite probable that international markets are also going down, albeit at a lesser amount or more a larger amount, right? Like but they're not perfectly positively correlated, right? So it's more like 0.6. Corporate bonds, of course, have oftentimes corporate bonds have an equity-like component, but given they have yields that are based upon treasuries, like the base yield, many times you'll see like corporate bonds be somewhere around like 0.2 to 0.3 in correlation. And then the big one would be like government treasuries, which historically, if you go back like over the last 100 years, typically U.S. treasuries have a negative correlation with equities, which is what makes them historically such a nice means of diversification to complement the equity part of the portfolio. Like there was a period of time where U.S. treasuries, it was like negative 0.6. So that's quite a bit of negative correlation. Interestingly, recently, U.S. treasuries have had a slightly positive correlation with equities. And I think a lot of that is, and that's happened in the past, by the way, in the 40s and 50s and even in the 60s. But a slight positive correlation. And I think that the main reason there is with the Federal Reserve being so accommodative, that has helped, both stocks and bonds, which is probably the main driver of treasuries having a slightly positive correlation to stocks over the last handful of years.
Awesome.
Great.